One of the best ways for federal employees to protect themselves during these uncertain times is to be financially strong. Understanding and building reserves is one of the critical steps to survive a period of uncertainty. We will discuss how the TSP, or the Thrift Savings Plan, could help in this case. In this episode, we share our insights on how to understand your expense categories, explore the different types of reserves you might already have and how long they might last, provide options if your reserves are not going to last for more than a few months, and action items to ensure that you're thinking about these options clearly. Hello, I am Zubin Kapoor, and I'm a financial planner at Valor Wealth Partners, where we are dedicated to educating federal employees on how to maximize their complex but often underutilized benefits. It is critical that you know your expenses and have an awareness of how it is that you're spending your money. I would start by gathering all my expenses and putting them into two buckets. The first bucket would be non-discretionary or essential spending. So this would include things like mortgage, rent, utilities, your groceries, things that you do need on a daily, monthly basis to get by. I would also include things like commuting to work, having lunch at work, your cost of medical coverage and life insurance and things like that. The other list would be a list of discretionary or non-essential spending. And these would be things like an unplanned holiday, eating out, and things that you can easily cut back on. Now, once you have a good sense of your expenses, you need to look towards income. So currently you have a job. If you're married, you have some spousal income as well. And then you look a few months down the road, in case you've lost your job, you probably still have your spousal income, and see that if there is any unemployment income that might be applicable for you. Let's talk about how we look at reserves. One should have a keen sense and a keen awareness of how much you have in your reserves and how they work. The way we categorize reserves are in three buckets. The first is emergency reserves. Now, suppose you had an emergency and you had to fly somewhere, you would probably just use your credit card and be moving. So the amount of limits you have on your credit card would be the amount you have in emergency reserves. Now, obviously, if you don't pay this off on a monthly basis, this sort of reserves could get very costly. The second type of reserves are what we call comfort reserves. So these would be about 1 to 3 months of expenses that are sitting in your checking and savings account that you use to pay off your bills, like the credit card bill that you had for the emergency from the prior month. The third type of reserves would be what we call catastrophic reserves. And these would be savings that cover about 6 to 12 months of expenses. These would be monies that's sitting in a non-retirement account that you can tap into easily. It would also include things like a CD, a high-yield savings account, or a money market account. Now, at this point, you have a list of your discretionary expenses, your non-discretionary expenses, your sources of income, and a list of your reserves. Now, let's get a sense of how long your reserves would last. By now, you have a sense of your cash inflows and outflows. If your income, either now or later when you possibly may not have a job, are higher than your expenses, that means you have a positive cash flow and you might be in good shape. Now, if you have a negative cash flow, that means your necessary expenses are higher than all your sources of income, then you have negative cash flows and you might be headed into trouble. At this point, add up all your comfort and catastrophic reserves and divide it by the number of total cash outflows that you have, and this way you will get a sense of how long your money will last. So for example, if you added your comfort and your catastrophic reserves, and say you had $30,000 between your checking, your savings, your CDs, and an investment account, like a brokerage account. And your expenses are running at $5,000 a month. So you take $30,000 divided by $5,000, and that would mean that you have 6 months of reserves. Now, if you are at a point where you don't have 6 months of reserves, or the 6 months of reserves makes you uncomfortable, then let's see what steps we can take to mitigate this. If you have reserves that are going to last you 6 months or more, and you're confident that you can find a job within that period of time, then you might be okay, and you may not have to take any drastic measures. But I would still think that it is a good idea to scale back on discretionary expenses. Now, some of you might be eligible to take distributions from your TSP without a penalty, and this would be the time to tap into it as needed. If you're more than 59 and a half years of age, you can take a penalty-free distribution from your TSP or an IRA. Public safety officials can get penalty-free distributions past the age of 50, and if you were eligible and retired after the age of 55, you can do so. Now, however, if you are less than 59 and a half and you retired under the VERA or a DSR, you are not eligible to take a contribution without a penalty. Obviously, you can take a distribution with a penalty and pay the taxes. Now, for federal employees with minimal reserves, I would look towards your LES. Now, please carefully consider the options that I'm providing and ensure this is the right one for you. In examining hundreds of LESs, I have come up with a list of a few things that you can consider. These tactics will help you build up your reserves while you're still working. Now, if you are putting money into a TSP Roth to take advantage of tax strategies, I would think about switching to putting your money into your TSP Traditional so that you can save a little bit on paying taxes now. This will help generate a little bit of extra cash in your net take-home pay. The other option is to reduce your TSP contributions to 5% in case you're contributing more. This will help build up some reserves in the short term and will also you'll still be eligible to get the 5% government match. It is better to have lower TSP contributions than incurring credit card debt. Now, in some drastic cases, it might make sense to stop contributing money into the TSP at all so that you can maximize the cash you get in hand to build up your reserves. And this might just be for a short period of time. Hopefully, you still keep your job or you find other employment. I've also seen that many of you donate money out of your paycheck. This might be the time to scale back temporarily. And then when was the last time you looked at your FEGLI option B and C levels? Could it be that you have not evaluated your options in many years and might be overinsured? This might save you a few $100s a pay period, depending upon what multipliers you choose and what options B and C you chose in the past. Another option is to take a TSP loan. Now, I know many people may not agree with this, but these are tough times, and sometimes you have to take drastic measures. The TSP loan as of February 25th can be obtained at about 4.6%, a rate that is much lower than incurring credit card debt at about 20 to 30%. Now, here's how a TSP loan might work for you. The first rule for a TSP loan is that you have to be working. So in case you think you need to take a loan from your TSP, you have to take it before the last day of work. There are two types of TSP loans. One is a general purpose loan. The other is a residential loan. But for this case, we'll be focusing on a general purpose loan. Now, how much money can you take out from your TSP on a loan? You can take half of the contributions that you have made over the years into a TSP with a maximum of $50,000. Now, while you're still working, with every pay period, they essentially garnish the loan amount or the amount that you have to pay back from your pay period. If you leave federal service, you have to ensure that you set up monthly payments so that you are still paying the loan and the interest back to the TSP. If you stop paying that monthly payment, it will be then counted as a TSP distribution, and you'll be subject to taxes at the very least. And if you're if you're less than 59 and a half, you will also be subject to the 10% penalty. Now let's wrap it up with a few action items. Take a good look at your reserves and decide if you need more or not. Doing a monthly cash in and cash out and looking at your expenses will help you for planning purposes. Now, try to get a sense of if you lost your job or how long it would take for you to find a new job. This would help you get a better understanding of how much you need in reserves and if you need to add to your reserves or not. Evaluate if a TSP loan is something that you want to take on. It is preferable to pay 4.5% interest as compared to high 20s on credit card debt. Before we sign off, researching your options will help you make informed decisions. Sometimes you need a little bit of help deciphering your choices. We want the best solutions for you and your family. Please get unbiased, conflict-free advice. Until next time.